Welcome to Dislocated but not distressed bonds that pay like equities in 2024 online webinar hosted by Cbonds company. I'm Anatoly Shkareda, Senior Business Development Manager at Cbonds, one of the top companies in providing financial market data with a special particular focus on bond market. Our company, apart from being a financial provider, also hosts a dozen international fixed income conferences worldwide every year. And we also, apart from just being a financial data provider and conference organizer, we also hold various webinars featuring distinguished bond market experts from across the globe in multiple languages. This evening, we're going to have a special webinar with a special distinguished expert coming from the United States of America. And I'm thrilled to introduce our special guests for this evening from Valens Research, a financial advisory company based in Cambridge, the state of Massachusetts, United States. Joining us are Professor and CEO of the company, Joel Litman. And I also welcome Henry Desai from the company. Good evening, gentlemen.
Good evening.
Thank you, Anatoly.
Thank you.
And thank you to Cbonds for hosting today's event. Good evening or otherwise, everyone. We are delighted that you've all joined us today. My name's Henry Desai. I lead the consulting practice at Valens Research, and I oversee much of our marketing, client services, and platform engineering efforts. And it's my pleasure today to introduce Professor Joel Litman. Over the course of a career that has spanned accounting, consulting, banking, marketing, and of course teaching, Professor Litman has been the embodiment of the independent financial perspective. He's the creator of Uniform Accounting, a process of corporate valuation designed to help investors make better decisions, not merely to power the Wall Street industrial complex, as so much other financial research does. His insights are regularly consumed by some of the world's largest financial institutions, including 200 of the top 300 largest money managers. In fact, they have proven so valuable that Professor Litman regularly travels to Washington, D.C. to consult with the FBI and brief the Pentagon on global economic realities. Today, Professor Litman will share his thoughts on the current market and credit climate, along with a salient warning and some thoughts on how to navigate potentially turbulent times. Without further ado, please allow me to introduce Professor Joel Litman.
This is The Intelligent Investor. The Intelligent Investor is regarded as probably the best book on investing ever written. I didn't say that. Warren Buffett said that. By far the best book on investing ever written. He didn't say equity investing. He said investing, and that's an important point. The second best book on investing ever written is probably Security Analysis, also by Ben Graham. And I don't know if people realize this, but if you scan through these two books, the terms debt and credit are mentioned more than 400 times. 400. Search on earnings, and you only find out about 100-something times. So clearly, the Security Analysis book, The Intelligent Investor, were not just about stock investing, which people normally attribute to Buffett, but both equity and credit and understanding credit analysis at a very deep level, as I have come to learn. Now, Buffett signed a copy of Intelligent Investor, and that signed copy, truly signed by Buffett, sold for $25,000 at an auction. And that auction, it was bought by a guy named Mitch Julis. Now, I don't know if you know Mitch Julis, but Mitch Julis is at Canyon Capital. That's Mitch. And he's regarded as one of the greatest credit investors in history. Greenwald says he's one of the best value investors, whether you're talking about credit or equity. And if it's any meaning, this is just from, 2012. He and his partner, Josh Friedman, split the $300 million. I'm not even sure that's their best year, where they were doing heavy credit and equity investing, but with the kind of analysis that I'm showing. So anyway, Mitch invites me in 1999. I was 29 years old. And he says, please speak at our first junk bond summit. It's going to be at MGM Grand, and appropriately MGM, because MGM has had some junk bond issues over its time. But either way, it was at the MGM, and they said, speak on it. And I said to, and one of the reasons they said, we want you to look at Amazon, because at the time Amazon was issuing debt already. This is 99. They're already issuing debt. And people are saying, wait a second, we got to rethink the risk of this debt. And one of the issues was that Moody's was ranking the senior unsecured at triple C plus, senior implied and senior unsecured at triple C plus, and even the convertible subordinated at triple C minus. And so they said, Does this hold water? Now, when I said to Mitch, I go, Mitch, I'm not sure I should be invited to this junk bond summit. He said, why? I said, I'm not a credit guy. I'm an equity guy. And Mitch said to me, well, you're an expert in the financial statements. You're a CPA. You're an expert in the accounting. And he said to me very nicely, he goes, look, man, he said, just identify the accounting issues. Just do that. And the people in the audience who are credit investors will understand and they'll translate what that means for the credit. And what he's basically saying is, just tell us, is the company really making money or not? Is Amazon making money? Can they pay these debts or not? Because everyone thinks Amazon doesn't make money. I mean, that was the big popular thing at the time. We all know what's happened to Amazon since. But even back then, I said, fine. And I said, there are a number of gap distortions, gap accounting that does that, by the way, that flow through to EBITDA also. It's not like EBITDA does anything other than add back 4 gap numbers. It's still very much a gap number, gap accounting. And I said, yeah, there's a bunch of things. I said, the accounting for R&D is not consistent across companies. It's not consistent even at Amazon from year to year. There's all kinds of stock option expense that is non-cash, but the accountants call cash. So don't tell me cash from operations is a good number. Cash from operations is a nonsense number. For instance, interest expense is still not included as a financing cash cost on the books of any U.S. company. It is still included as an operating cash flow. So are stock options, so are pensions, leases. Inconsistent lease makes it show up in different places. So anyway, I said, there's a whole bunch of things. I said, Amazon is a lot more operating cash than anyone thinks, a lot more than GAAP accounting certainly is showing. And to do this, we actually have about 130 adjustments under GAAP or IFRS to look at. And there's just 6. I show 5, but there are 6 that really mattered for Amazon. I said, when you add those back, Amazon should have no problem paying its debts. No problem. Moody's is wrong. And that was my big statement of the day. And, thank goodness Mitch was there to give me some coaching along. And so obviously this is wrong. They paid off well. So any investors in that did very, very, very well because the bonds were trading way off of par because of these horrible ratings and the quote unquote, what do people say to me? The headline risk. And I said, this is the issue, the accounting issues. And this changed my life because after 99, after Mitch, I said, okay, I'm not an equity guy. I'm a financial statement guy. And whether you express that in, does that mean it's good for the stock or good for the bond or bad for one or good for the other, is dependent on where the cash flows are going, the real cash flows, which GAAP and IFRS do not represent. The statement of cash flows is garbage. It is nonsense. Anyone that thinks otherwise, I'd love to have another several hours with you if you want to understand the intricacies of why cash from ops does not represent cash from ops. And I give you a few reasons here, but I'm going to show you a couple more with some real examples. So I said, all right, that changed my life. I'm a different person. And it leads to the business that we've built today. So Marty Whitman, I realized, one of the greatest credit investors in history, God rest his soul, passed away just a few years ago at 3rd Avenue. And Marty Whitman said in his book, generally accepted accounting principles are not truth or reality. And EBITDA doesn't fix it anyway, right? ITDA doesn't fix 130 adjustments. It's only 4. And I'd argue it's not even the right 4. Fitch ratings, for instance, Fitch says, and I'm just showing gaming because, we were talking about MGM. And when you look at Fitch, they said, well, here's what we use. To analyze companies, we use EBITDA. And we also use EBITDA margin. And we also do this net debt to EBITDA. And we also do this regular debt to EBITDA. And then let's throw in an adjusted debt to EBITDA as if that would make a difference. And I don't know if you know this, but Seth Klarman at Baupost, Seth Klarman, by the way, wrote the foreword to security analysis, so clearly a follower of Ben Graham's and an understanding of GAAP accounting does not tell what's going on. And by the way, this is the S&P 500. That's that red line. This is Baupost performance, crushing the markets, made billions of dollars for his clients over the years. And what did he have to say? Seth Klarman said, I don't know why investors of any kind, he didn't just say stock investors, I don't know why people are accepting EBITDA as a measure of corporate cash flow, because it isn't. He said, EBIT isn't even that good, and adding back D&A is just crazy. Depreciation is not a non-cash item. It isn't. They would say, oh, depreciation, that's non-cash. No, it's a smooth estimate of actual maintenance CapEx. It is. And it's a really good smooth estimate by that standpoint, meaning the money is not going to be there. It just isn't there. And so he said, don't use EBITDA. Meanwhile, S&P, here's their ratings methodology, and S&P says, I just did a quick search. How many times does EBITDA show up in this document? It shows up 57 times. Clearly, there's something going on wrong with these corporate credit ratings at the big three, which is why I think they mess up so often, which is why we cannot rely on them. We needed to build something better, right? A better mousetrap, a better thing for investors to understand, right? Because you will see things trade off, and some pensions and some allocators are not allowed to buy things that would otherwise be investment grade, but are not because S&P, Moody's, or Fitch says, oh, it's not investment grade, and so the prospectus says then we're not allowed to buy it. That creates some wonderful dislocations for investors that can buy those things, or for those that are just worried about what they say is headline risk of the S&P. Charlie Munger, one of the greatest investors in history, just passed away, my goodness, in just the past few months. The horrors of EBITDA, the horrors, Charlie's awesome, of EBITDA have been understated, as has the disgusting nature of the people that brought that term into use. All right. Here's Moody's ratings of Delta Airlines. And Moody's gives Delta at the time, this is 2014, double B minus. That is junk. That means 8 to 15% chance of default, according to them, anyway, of default. And they said, and here's our analysis. It's based on EBITDA margin. Really? And it's also based on EBIT, which we know no great investor would ever rely on. And then there's debt to EBITDA, as if that tells you anything about what's really going on, because they don't. These are bad metrics. Bad. Anyway, what did Warren Buffett have to say about this? He said, people who use EBITDA, watch out. I'm sorry if I'm offending any of the participants on the call. There are a lot of people dialed in right now. People use EBITDA are either trying to con you or they're conning themselves. Right from the words of the Oracle. All right. By the way, these are debt experts. They're not just equity people, as the books would show, right? Because it says more than 400 times. So clearly, there's something wrong with Delta Airlines at double B minus. Now, here's what we do instead. This is what we do. We do this for literally thousands of companies. We update it only weekly. We don't update daily. But this is the gross operating cash flow of Delta Airlines, somewhere around 10 billion or something like that. Gross operating. That is not the number from cash flow from operations. That is not EBITDA. That is not EBIT. It's actually if you take 130 adjustments and say, what is the true operating cash flow of the firm using uniform accounting? That's one uniform global accounting standard, not IFRS, which says, oh, it's a standard. And then Singapore has Singapore FRS. And then Philippines is Philippine FRS. And then China says, oh, we follow IFRS, but they call it Chinese accounting standards. And then they adjust IFRS to whatever they believe they want to do. All right. And so it's all off. By the way, this is the cash available. They had another 4 billion of cash available, just sitting around, waiting to be used if needed. And they had an empty revolver of another couple billion, ready to go if they need to use that revolving loan. Just like that. So that's the cash total available, something like 14 billion. Now, what do we compare that against? Total debt maturities, this is 2015's estimate. We're in 2014 looking at 2015. That was debt service. That's a known number. You can get that number. Right? It doesn't matter how much debt is due in general. What matters is it due next year or in the next 5 years or 7 years? Particularly if you're buying, I don't know, a 2020 bond, why do you care if they have lots of debt due in, I don't know, 2030 or 2050? If you're buying the debt, here's the interest expense. That's a known number. Here's the rental number they need for all the leases of all the planes and everything. Here are the dividends the company's paying. Here's the R&D. They don't have R&D, but if they did, we'd call it that. Here's pensions. They do have pension servicing costs. They do. And then finally, maintenance CapEx. That's the amount that they probably will spend to keep their fleet up to date. Now, they could push that back a little bit if they wanted. They could let the planes get a little older. They could let the seats get a little older if they needed. But even if they didn't, even they kept everything brand new, brand useful, and what have you, just tell me, is there any chance this company's going to default in 2015? I would say impossible. Even if the cash flow from operations got cut in half, they had a horrible, horrible year. It got cut in half. They would still have enough excess cash sitting on the books, plus a revolver with which to cover things. And by the way, if they really had a bad year, what if they just said, hey, let's cut back on maintenance CapEx, cut back on pensions, cut the dividend if they had to, just make the necessary payments. This is a massive cushion. Massive cushion. There is no way Delta Airlines was going to go and default in 2015. No way. And even if they did make all their payments, they still had a massive cushion. Now, in 2014, you could forecast 2016. You could forecast conservatively for operating cash flow 2017, 2018, go right through to 2021. And if you did all that, you'd say, what on earth is Moody's talking about? Well, I don't know, because EBITDA is a bad number. It includes all kinds of non-cash expenses that don't represent what the company's true cash flexibility was. So this is back in 2014, and we told our clients, this is good money. There's good money bonds sitting in here. Really good money bonds. So our credit rating was IG3, A3, if you want to call it. Moody's was sitting there double B minus, deep junk, right? Fairly deep junk, I'd say. It's not just like a crossover. And we said, but what's wrong with this picture? It's a beautiful picture of cash flow. Even if they had a bad year or two or three, there's so much cushion between that blue dot, right, and the debt. Not to mention if they finance some of the debt out and kick the can down the road, there is no way this company is defaulting. This is investment grade through and through. So we recommended it. There were a couple of certain bonds that we really liked. And we came up with that rating and said, we think this is good money. Because once you fix all the gap on IFRS accounting, you get a totally different answer than the big three corporate credit agencies would even consider. All right. We actually calculated the CDS, not calculated. We pulled the CDS. It was around 259, 260. We said, that's all right. That's not quite super junk, but that's a lot higher than an investment grade name would be for a credit default swap, right? That was the actual CDS at the time. All right. But our intrinsic CDS 5-year, we calculated by doing this algorithm. We just do an algorithm of all the cushions. What if they didn't make their payments? What if they were able to pull back? What if they cut their dividend? Things that may be bad for the stock, but are great for the credit investor. They are. Maybe not for the convert. We also looked at total cash versus all debt service of the next 7 years. We also look at basically an importance of the first year versus the second year. We looked at the major cushions, which occur over the next 5 years, particularly if we're looking at a 5-year CDS. Right? We looked at the trend in the return on assets, which was trending upward. We can benchmark that against other airlines. These are algorithms we throw in. We look at all the debt stack. We look at the recovery rate, a real recovery rate, not that Bloomberg number of 40%. It always says 40%. I'm like, how can every company have a 40% recovery rate that Bloomberg would report when you look at that Bloomberg screen? No, for some companies, it's really bad, and some companies, it's fantastic. So we look at all the debt due, all the loans, all the terms, everything else, EETC, you name it. And we came up with an intrinsic CDS. This is purely algorithm driven of just 97. We said, this is where the CDS should go to when people realize how solid this company is. And we think it's a headline risk and whatever that's creating the CDS. Brother, this is 2015. It's not like it's 2008. It's not like it's 2001 post 9/11 and no one's flying. I mean, there's people flying in 2015, 2016, 2017. So anyway, we said the ICDS 97. And if we looked at it, Delta's credit default swap around 300 at the time of this analysis. As that number fell to 90, which it did, the actual CDS fell to where intrinsic CDS was. It took about, a year and a half or so. And of course, what did the stock do? The stock went up, I don't know, a lot. 400%, 400%. Now, you can express your investment either in stocks or in bonds, right? Or in, I guess, shorting a CDS if you wanted, depending on what you do. But either way, there were some wonderful bonds that were there that were trading way off, paying really high yield to worse, that were far more than the true risk of Delta deserved, which for the investors that took advantage of it really made a nice killing in bond world, meaning doubling or tripling the Barclays high yield, if you will, because of how these EBITDA measures and these gap-based and IFRS-based measures are littered throughout the corporate credit ratings world. I can't, to this day. So who's Valens, right? We got 150 plus people. We literally cover 32,000 equities and credit across the world using this kind of analysis and these algorithms, right? Getting everyone on uniform accounting, cleaning up every of the financial statements. A lot of it can be done on automated, not always, but of course to do 32,000, we do a lot with a very good set of automated numbers to get it. We have 44,000 subscribing investors, buy-side entities, which includes mass affluent, family offices, you name it, government, Pentagon is using our work. And me and myself and Rob Spivey and Henry Desai are helping run this business. So anyway, we restate to these companies. We flex this database. Here's another example. Now, this was in Barron's. You can Google it. I got quoted in Barron's for this. Cash from ops was negative. That's the reported cash from operations according to GAAP accounting for AMD, the chip maker. And because of it, stock trades down to $2.50. Very, very cheap for the stock, right? Cash from operations was negative. In reality, cash from ops, the true cash ops number, when you back out all these non-cash goofy items, was easily $1 billion. Easily. Add back non-cash pension expense, add back non-cash stock options, add back a bunch of other things. This company was really minting operating cash flow. And we said, it's so obvious this company will not default. By the way, if I show the debt service, it was nothing close to $1 billion a year, nothing even close. But CDS had traded way up in the several hundreds, and stock traded way down. And our forecast for 2015 and 2016 were that this would continue. This operating cash flow would continue, and that cash from ops would continue to show something negative, which is exactly what happened. Cash from ops kept showing a negative number. However, real cash from ops, the blue, the true blue, under uniform accounting was saying, no, there's real money here. There's real money here. AMD's credit default swap at the time of printing in Barron's, at the time of printing, was 660. 660. That's deep junk. Where did it go to over the course of the next couple of years? AMD stock was at 250. The credit default swap traded down to 60. And I got to tell you, there's some beautiful bonds way up there back in 660 land. The default swap, you knew there were bonds playing these phenomenal yield to worse, double-digit percentages, really nice names. Now, what happened was credit default swap traded down. People realized, wait a second, this company has a lot more cash, it seems. They have no trouble handling their debt service, no trouble refinancing. And the stock went up to 48 a share, right? 30-something times, right? Amazing. Now, it's gone up way after that because people realized the AMD chips were used in mining crypto. We will not take credit for that. We'll just take credit for the move in the stock from the move in the CDS because the company was not truly at risk of bankruptcy, despite the legacy media, the mainstream media, the big three credit agencies were saying. This is, by the way, just a couple of years ago, AMD's corporate credit ratings were still double B minus at Moody's, or double B, or double B minus at S&P. Still, as of just a couple of years ago, as if they still hadn't read the memo. Stop using EBITDA, stop using EBIT, and do the real work. Then the work is you really got to dig through all 400 pages of the financials to get to the real numbers, the true cash flows, the true debt service, to understand the flexibility. And they're still in the dark ages. Still to this day, the big three in the dark ages when it comes to this analysis. So our high conviction bond recommendations, and we sell this for $5,000 a year. But I'm going to show you what this is. This is our bond service. We just say, here's the names we see. Here's what we think we like. Here's what's showing up. And of course, in doing that, we use our CDS versus the trading CDS. We look for dislocations, right? Meaning it looks like it's distressed, but it really isn't. It's really an investment grade or a crossover name, but trading with really, really bad. We use our full charts of credit cash flow problems, those charts I showed. We do fundamental forensic analysis on the company, on management itself. We do earnings call forensics. We actually run technological audio forensics on the calls. We put in our global macro themes that we're seeing from having 32,000 companies. We see, are there any big industry trends that might pull down an otherwise good company or whatever? And we look at the equity markets to say, what are the equity markets telling us about the credit, and vice versa, just like Canyon Capital or Third Ave or others would. And we look at the incentives. Is management being paid to do what's good for credit, or are they only doing something that's just good for management, like being paid on earnings per share? Because earnings per share is usually a bad metric for credit. So is EBITDA. Anytime you see management being paid on EBITDA or EPS, credit investors should run for the hills. It means management's being paid to do things that are bad for the balance sheet. Really bad. I can get into that later. But so here's our 2016 return, 31%. Barclays high yield was 14 that year. Here's our returns in 2017, 10%. The yield on the bonds we recommended, Barclays was 6. And you can go down Today, it's around 80% total versus Barclays of 41% in the service. By the way, we'll give you a discount because you're sitting on the Cbonds call. For anyone that's here, we'll cut that cost in half from $5,000 to $2,500 if you call in because you attended. Anyway, that's performance of the time. 126, a 97 win rate of 126 recommended bonds. Not one bond that we've recommended has ever defaulted. Not one has ever even defaulted. We've got some where the yield didn't turn out to be as good as we'd liked, where the company just didn't, trade off as well or whatever else. We sold before maturity because there's something we didn't like, but we still didn't see a single default of the 126 names. 97 were winners, and that's how we got to this 80% over 41. So let me give you some real ideas right now. That's the performance versus Barclays high yield, crushing Barclays high yield bond ETF with the conviction credit ideas. And that's literally from buy date to sell date. You can track it. It's published. Here's our real recommendation right now. Coles 2031, 4.625. I use Cbonds to look this up. And in Cbonds, you see this. And it tells you right away. Let me focus in on one area. It says, oh, the big three really don't like this. All right, at least Fitch is at triple B minus. It's still crossover. But Moody's is a double B minus. That's junk. S&P's a double B. That's junk. And that might be a headline risk, quote unquote. I always hear that from bond investors. Oh, I don't like it as a headline risk. Who cares about the headline risk? If you're going to hold to maturity, you're still going to make your money, right? And so what I find is Cbonds does have more accurate data than I get in some other places. I'm just being honest. This is unsolicited testimonial. Cbonds has given us their database for a while now to use and play with. Here's another area. Look at the yield to worst. Look at the yield to maturity. 8.8%. So you're getting the equity markets on average over time do 6.5% real. 6.5% real. You're getting 8.8% here, right? So real plus some nominal amount. You're getting 8.8%, right? Yield to worst. And let's see, right, on this. Well, the credit markets are materially overstating this. The yield to worst, I said 8.6. It's probably close to 8.8. I do think Cbonds is more accurate than that 8.6 number. And a CDS of 465 bips. 465. That reflects junk, right? But let me show you some pictures. First, this is just the base case. So that blue line is the operating cash flow. The operating cash flow is more than enough to cover all payments. The true operating cash number, more than enough to cover all payments that Kohl's, broadline retail, that Kohl's may have. And we did all kinds of forensic analysis and other things to it also. So it wasn't just this chart, but this is the chart that alerted us to it, the operating cash flow. The excess cash line, the blue dot, sails way above all debt service. And they have an existing revolver, what's empty right now, that they could avail themselves of, that would more than double in some years the cash necessary for their payments. Now, there are a couple of head walls there. I think you can see the head walls. One is 2025 and one is 2028. All right, there's a couple of head walls where they have a bunch of debt due. But one of the things I'd say is, let me just show what if they refi, because it is not a terrible refi market right now. It might get that way, but it's not terrible. Interest expense might be higher in a refi, but that's fine. They've got the money to cover it. But let's say they get out of that. Just watch. All right, that's if they kick the can down the road. So they still make all the other payments they need to make, but all I did was knock out the debt service those 2 years. Now the company's sales, this is investment grade. It's sales above it. The blue sales above the required payments. Now let me cut back on, refurbishing the stores. Let's say they let the stores get a little older. They don't have to refurbish the stores every year. So let's say that the stores get a little bit older. Even more of a cushion. What other flexibility do they have? They can also cut the dividend. Bad for this investors, but for credit investors, companies will cut the dividend long before they go bankrupt. There is no way this company is going to default, even if they have a really bad year, even if their operating cash flow is half of what's expected, even if it's a third, the operating cash flow is what's expected. Let me say it another way. Even if it's close to zero, as long as they refi out and cut back on some of the things, this company's money is good money. It is. It's good money, these bonds. And yet, we're getting yield to worst of 8.6. We'd argue the intrinsic CDS, and that we calculate for every company, should be somewhere around 230. Those two head walls do give us concern. Kohl's is not a giant company that, it's too big to fail. But the implied yield to worst of 6.6 would already be fairly priced, and you're getting 8.6%, right, on good money bonds, right? Sit on them to 2031. We like it. We think that you won't have to wait till 2031. At some point, the market realizes, hey, wait a second, Kohl's doesn't have these issues, or they just refi out those 2 years ahead walls. Refi that out, and suddenly, man, that par is going to pop like crazy. It will, right? And you'll still there clipping that coupon, even though you paid something so much less. So we really like Kohl's at this level. This is one of the bonds that we're currently recommending right now. So you're getting this for free because you're on the Cbonds call. And Moody's is just grossly overstating. They're calling it BB minus at S&P, and we're saying, no, this is investment grade. We'd call this BBB plus. IG4, investment grade 4, or BBB plus. That's what we'd call it, given what I just showed you, based on good accounting, based on good analysis, and with cushions that even if Kohl's had a bad year or two, a really bad year, you'd still be like, it's all right. I'm still going to get my coupon. I'm still going to get my bonds at these deep values you can pick it up at. Second idea is AMC Networks, 2029 bonds. That's not too far from now. 4.25 coupon. All right. Look this up in Cbonds, and what do you see? Oh, my goodness. Look at this. The ratings agencies, Fitch isn't even given a rating. I guess Fitch, they didn't pay Fitch to do it. Single B minus at Moody's. S&P, all right, they got single B plus. All right. No, I guess, Moody's single B plus. I always have to do the conversion in my head. And then straight up B, all right, at Moody's. So still really deep. I'd call it deep junk. This is not crossover. All right. And what are we getting? Holy moly, 13% maturity. That's a better number than I thought. I thought it was around 12 something, right? 13% yield, right? You're getting Cbonds is saying. So interesting if you screen for that. Now, let me show you the work we did. The grossly overstating. My yield to worst was 12.6. It's actually closer to 13 right now. I trust Cbonds number more than where we pulled our reference data anyway. And here's AMC Networks. Now, you do see a couple of head walls there again. Let's see, that's 25 and 26. So true operating cash flow is more than most of this, with exception of a couple of years that they'd have to get through if they relied on operating cash flow alone. But if you include the blue dot, the excess cash number there, the cash on hand and the revolver, there is no chance this company defaults. And this is AMC Networks. This isn't the AMC movie theaters. This is the TV station. This is an asset-light business. And so, all right, they got a couple of deadhead walls. This is not a bad time to refi. So if they refi out, what happens? Ta-da! This is investment grade 1 or 2 or something like that. This is amazing. These operating cash flows, plus cash on hand, plus the ready-to-go revolver that's still empty. Right? This company, even if it had a horrible year or 2 or 3, would still be more than enough to cover its interest payments and everything else that the company needs, maintenance, CapEx, you name it. This is after all cost of goods sold. This is after all payroll and everything else, right? Those are required debts, and there's your operating cash flow, that blue line. This is good money bond, AMCX. This is a good money bond, right? Now, if they don't refi, all right, they're going to have a little bit of trouble, but this is not a terrible refi market. It might be at some point. I would tell management, hey, refi soon. But imagine the white knight who comes in and does refi it at these rates and gets some juicy interest rate, thereby self-fulfilling prophecy. Company gets out of risk of default, pushes their debt maturities down the road, 5-10 years. Man, they could do that with private placements almost. All right. So grossly overstating with a yield to worst of closer to 13, according to Cbonds, right? An intrinsic CDS, right, we'd say a 458, right? Not the high levels that the world is saying. A reasonable yield to worst would be 8, even with current debt maturities, let alone if they're refi. And here's Moody's sitting there. So we think Moody's and others are keeping people from looking at these particular 2029 4.25 bonds that look really interesting. By the way, these are so liquid, retail investors could buy them. These bonds are available on Schwab. You could type in the QSIP, and you individually could buy these bonds. So there's liquidity. All right, this is not like there's no liquidity in these names. So that's 2 of the bonds that we have in our conviction list right now. In case you're interested, I'm not trying to be overly sales, but people do ask, and contact me or Henry, and we'll figure out a way to make you a subscriber if you want to our bond lists. Right. Lastly, now I'm going to flex a little. Take those 32,000 companies. Very safe, let's call 0.99. Somewhat safe, 100, 4.99. Riskier junk, let's say it's 500 plus. Right now, actual CDS in the US is 288 names. We'd say 150, 125, and 11 for risky. That was 2019, by the way, 4%. Now, we run ICDS on these. We get 1640 names. Now, that says there's a lot more at risk in that somewhat safe area than the CDS numbers would apply. But still, a very low and very safe, super risky, super junk based on our intrinsic CDS. 2021, similar. Not so bad. Now, the credit markets, commercial lending, is drying up. It's true. So if you're dependent on commercial lending, you're in deep, deep trouble. But if you can get private assets, private credit assets are booming, super liquid right now, right? And bonds right now, still super liquid. You could still get, right? It is not so bad. Now, let me show you where the big credit crisis is, my piece de resistance of my final slides. Anatoly, I probably went over a couple minutes, but let me show you China. This is China, Hong Kong, and Macau, where there are almost no CDSs traded. Almost none, right? But from an intrinsic CDS, we are covering 5,700 companies. Of those companies, 1,900 would be risky. Did I just say that? Yes. 34%. 1 out of every 3 publicly listed companies. It's not just real estate. Every sector in China, every sector, if you had CDSs traded, which you don't, but if you did, you would see 500 and above. It's scary. By the way, this is an IT company in China. IT. This is not a real estate company. Look at the cash flows, the blue. Look at the debt head wall right now, plus interest, plus just keeping the lights on. And it doesn't look much better if I go down the road. This company does not have the money to fund it. And I'm telling you right now that ICDS of 900, there are 1,900 companies in China that look like this right now. It is a massive, massive problem. It's horrible. China is uninvestable. Equities are going to be down 30 to 60% this year amidst a credit crisis that'll be worse than the US 1929. Worse than anything you saw. It is the lost 2 decades for China that we're coming into. It's terrible. Versus the US, where you get some wonderful, wonderful opportunities like I've shown. So if you like what you saw, yeah, link it to me. Here's our information. And Anatoly, sorry if I went over a minute or two.
It's okay. Thank you very much, Professor, for your presentation and some snapshot, very interesting investment ideas. And since the webinar is divided into 3 parts, we will proceed with the second leg of our event, a short presentation of the Cbonds platform. To do this, I will be joined by my colleague, Lana Veselova, International Relations and Global Clients Manager at Cbonds, who is like joining me from a different office. Lana, the floor is yours.
Thank you so much, gentlemen. It was amazing to follow you. And thank you very much for your ideas. Frankly speaking, let me also start sharing the screen. And those bonds which you just recommended, really rating agencies, they are keeping us these bonds to be absolutely unseen for investors, I should say, because frankly speaking, I don't look at bonds, especially like B plus something, or well, very rarely double B, while these bonds, the performance and all their financial reports. Sorry, I'm also pretty conservative and look for the financial statements, their EBITDA, and other thoughts. How that's really very fantastic how you can apply those links in order to see how this company will be performing. So yeah, their financials look really very nice, and these bonds are really attractive. So thank you very much for very interesting thoughts. I'll definitely explore it a bit later. So let me probably start from maybe the very beginning for those who just joined us and still not aware of what we do. So basically, my name is Lana Veselova. I'm International Partnership Manager at Cbonds. usually help companies to find data solutions, but of course, among our clients, there are many private investors who are also curious to find very interesting, appealing opportunities in the market. And like today, we seen those bonds which are really very appealing and giving very good profit in terms of yield. I would say this is something new, I would say, with such ratings. So today, I would say I wanted to make more practical overview of our database. So as you can see, Cbonds has a pool of investment ideas because we cover all bonds globally. These are 800,000 bonds, no matter from which country. Yeah, of course, you might have some preferences for developed markets. Try to be very cautious with the emerging market areas, and definitely you need to be fully equipped in order to investigate Asian investments. That's totally agree with Mr. Litman. So today I wanted to present actually our new service which we do for our clients. Of course, many of you are using our bond screener in order to find different ideas, but we try to make things easy for you because this is what we do. We want to care about our clients, and we wanted to see to provide you our observations, those bonds which changed their performance, which are dropped down in the price or which are raised in the price during the last week. So you have some list of bonds. I would say, of course, it's not a suggestion, but definitely the list of recommended bonds for your more careful look. So today, I want to present a few bonds from EM. These are gainers, who gained a few points within the last week. I'm happy to share, of course, all the data with you afterwards, so you could study it carefully and don't take notes in a rush. But frankly speaking, I like our second part of investigation, those who drop down in the price. Someone called them losers, but I call them some investment opportunities which could basically give us a bit more yield. So let me start with a few names so we could have a look. Sorry, it's my homework to study. So basically, these are a few bonds which I added into my watch list, where I basically track different bonds. Besides, apart from that functionality that will give you the newsletter that will warn you about those bonds which changed within a price, of course, you are able to set your own price triggers for those bonds which you like. And basically, once the bond drop downs in the price, make sure you buy the very best price. So one of those bonds were like Intel, very good, secure company with good profits. And as you can see, their performance, the liquidity is very nice. You can see how it is traded. This is the quotes from stock exchanges today, basically with 15 minutes delay. You can see how this bond is traded among stock exchanges, market participants. And of course, you can refer basically to our average market price. I would say this is fair market price, how this bond is traded between OTC and between stock exchanges. Of course, we recommend to study all the details, the ratings, the covenants, because we analyze prospectuses instead of you just reading all 700 pages. We do it for you. So you can see the list of institutional holders. These are the funds who hold this bond in their portfolio. So basically, it just gives you the idea that this bond is worth of your attention. Make sure that you studied all the financial reports. And of course, you're able to compare with maybe some other company. So among those were Electricité de France, also very stable, good European issuer, where you can see, well, more or less standard yield within 5%. And for example, let's compare it with this Intel. So let's go directly to our trading chart and let's compare. So basically, this Intel is yellow and the blue one is electricity. So you can see which one gives more interesting yield for you. And of course, you can visualize the spreads and the spread between them. Also, I would say we continue the idea of phone communication. So there were several Roger communications with pretty long duration, where you can see that the performance is pretty interesting. So you can buy this bond at 72, 73 and gain just a bit more on the price. And the second, and these are two, with one for comparison. So they are pretty close, but one is just a bit cheaper in terms of purchasing. But I would really recommend you to study in a more careful way afterwards all these bonds. Among communications, again, also Vodafone Group, which gives you just a bit more yield with 6%, with a very good rating and very nice one, I would say. So they recently had like 100 and now drop down in the price. So take a closer look at them in order to gain more interesting ideas. So I would also want to highlight a few our tools. So apart from different tools, I would say this tool really needs your attention, because the bond search allows you to screen all the universe of bonds which we cover, which around 800,000 bonds globally. You can apply different filters from rating, yield, price, anything you want. And most importantly, you are able to visualize this data on the yield map and export the data in Excel. In order to show you, let's do a bond search. So we are at the bond page. Of course, your criteria might be just a bit different, but let's start with the international bonds. In USD, with the yield starting from 6 up to 15. It depends actually which duration you use. Mainly, of course, it is up to 10 years. Although right now I notice there are so many opportunities with the bonds which has more duration than like mid-maturity. So take a closer look to different options. So I would always recommend you to apply rating level. In case the bond is not rated by all the rating agencies, you can apply, for example, max rating, because ratings are a pretty expensive thing for the issuer, and they might not always rate either issue, either themselves as a company. So try to use at least one rating. In case you're specialized in some particular type of bonds, and apart from the conversation we had, we also discussed with Mr. Litman the convertible bonds and maybe some other bonds which you have the focus on. So feel free to apply different filters, and you are able to find those bonds which basically you're interested in. Maybe it could be just excluding subordinated bonds, or only perpetual bonds, green bonds, whatever you need. I would also recommend you to filter according to the volume of the issue, or for example the minimal settlement amount, in case you're a private investor, so you can limit those bonds which are, I would say, affordable. And you can always apply the filter by the price. So for example, those bonds which are traded below 98, for example, and the coupon, it should be, for example, fixed and starting from 5. So let's assume you done the search and you are able to screen the market. You are able to, as I already mentioned, export the data in Excel, and of course visualize all your search results on the market map. Apply different benchmarks. So I used USD because I made the search for USD denominated bonds. You are able to see all the filters which I applied, and these are all your investment opportunities which you need to investigate with the help of our bond screener. And of course, if you do such query pretty often, we have saved queries, so feel free to be warned about other bonds which match all your criteria. Everything will be updated for you. Apart from bond screener, we also have a Watchlist. Watchlist will help you to track bonds automatically. And this is also one of the most important things which you need to do, because you can spend your time in a more pleasant way. We can do everything automatically for you. You can get automatic updates on your price, yield changes. You can receive email alerts in order to be updated in terms of changes of ratings, or maybe new financial statements, or the next coupon, so you could reinvest. Our Watchlist tool will allow you to track bonds, stocks, and indices in one go, just like here. You can see the price changes, the yield changes. And of course, you're able to track some indices in order to be updated what is the market, what is going on with the market. You can see what is the general index, for example, for US corporate investment grade bonds. What is the general yield, or what is the inflation rate? Or what is the CDS of particularly country, and you can foresee maybe some events on the market. Also, we have Cbonds tool, which will help you to track your bonds in automatic way, but directly in Excel. So if you are a pretty conservative person like me, if you like to make a few comments in your files additionally, which are not allowed, for example, within the functionality of the interface, feel free to add formulas to your files, so they will be updated automatically within our Excel add-in tool. So it is relevant for portfolio management, but of course you are able to have updates on the macroeconomic statistics. You can open the file with all the sovereign bond yields or CDSs, or maybe some other indices which will help you to track the market. And of course, as we already mentioned, you already seen Cbonds is available on the website tool. This is very user-friendly tool. You're able to use it in Excel directly, but of course with the help of our mobile app, in order to track all your bonds in a quick and fast way. So in case you are interested to give it a try and explore our bond screener, feel free to contact us directly. We have incredible team who will help you to define all your needs, to find personalized solution and help you, because we tend to make very personal approach within our company. So you can use all our data and apply all your special lenses like Joel today made, and define which ones can enrich your portfolio this year. Thank you very much for your attention.
We have some questions, for example, from Polanile Patterson, if I'm not mistaken. I'm sorry for mispronouncing maybe. Can you convert a registered bond or in entity into stock certificates? And the second one, can you transfer a current registered legal entity identifiers to Cbonds from Bloomberg? Well, I believe that the question, when it comes to us, we're just data provider, right, Lana?
Yes, absolutely.
Yeah.
So there's no possibility to convert any bond or anything at our platform. We are data aggregator. We gather information and provide you all the detailed data for particularly bond or stock or ETF.
And allow me to just provide my endorsement, right? We're providing research and ideas, but we don't have anything like Cbonds. I mean, it's interesting. So if we say we really like AMC networks for a particular reason, yes, we're providing one bond that we like. But if you said, well, I like it, but can I find another bond with a shorter duration? Or I want to look at the covenants in detail. I mean, this is where you'd say, all right, let me look at AMC networks, but use Cbonds. I'm just being very open because I do like the product. I'm saying you didn't ask me for the endorsement, but I'm giving it anyway. Anatoly, which is, the ability to say, all right, maybe I like AMC networks, but maybe there's a different bond in the bond stack that's higher or lower in the duration, or higher and lower and whatever, that better fits what you're looking for. And if that's the case, that's where it's such a nice compliment to use Cbonds with the research, because we're not providing that kind of data. We're not a data provider in bonds, and there may be something else that's really interesting with Coles. Then you say, oh, there's a different maturity or a different whatever that you like, even if you like the whole. I know you're asking for that, Anatoly, but I do like Cbonds, and for that kind of usage, it's very, very, very useful.
Thank you very much, Professor. I really appreciate your words. Thank you very much. Appreciate your participation and your analysis. We actually have some questions. If you don't mind, maybe just both of you, or for you, Professor. Like the general one. Since we're actually discussing bond investment opportunities, we can't just omit the fact that the audience and the public is interested in your kind of analysis and forecast when it comes to the next Federal Reserve interest rate policy decisions this year. Do you actually anticipate the Federal Reserve that begins easing its monetary policy this year, or maybe it will be like a very tough year for Federal Reserve yet to ease its policy?
Yes, so one of the things we do is, when I mentioned the earnings call forensics, we actually run people call it a lie detector, but it's actually a cognitive analysis, cognitive dissonance and resonance on Powell's actual statements. And we also run our own analyses on inflation and employment and what have you. We do not believe the Fed in the U.S. will be lowering rates anywhere as fast as the market is predicting. Powell is not worried about the stock market. He's concerned about two things: employment and inflation. And as long as employment is as strong as it is, he's concerned about wage growth, and frankly, what's going on in real estate actually going up still way beyond what the CPI is from an inflation standpoint. So as long as he's still getting all kinds of inflation prints that are well above 2%, because he is wedded to that 2% number, as long as Powell keeps getting inflation prints of various kinds that are way above 2%, not just the CPI, but other stuff like on leases and whatever. And on top of that, such strong employment, he has the ability to say, all right, since employment's as strong as it is, I'm going to keep rates at a higher level than people think. And so we do not see rates getting cut anywhere the way the market reacted to something he said at the end of last year. And we thought he said it prematurely, where he said, oh, I'm going to start to look to cut rates. And the market was like, that's it. Wonderful. Rates are going to come down, by a half of where they are now or more, maybe a third of where rates are now. There's nothing that tells us that's going to happen from the data we're looking at on a macro basis when we look across what the Fed is seeing. And we think we have a pretty good understanding of Powell and the Fed and what they're looking at. They are a two-punch boxer, and their two punches are left for inflation on one side and employment on the other. And both those say, why not keep rates at a higher elevated level for a much longer period of time than the markets are suggesting. So I think people that are banking on rates falling are going to get a rude awakening over the next few quarters, as the Fed will not cut anywhere near as much as people think.
And still we have like no recession or soft landing in sight, right?
We think there could be a recession, economic slowdown, but this is something that the Fed says, a recession in name only, meaning there's a recession and economic slowdown, but unemployment stays very strong on one end and inflation print is still strong. Why wouldn't he still cut rates? Right. Yeah, I think his bigger worry is if he cuts too fast, that we get a whipsaw and 2025 ends up with super high inflation again because he cuts rates too soon, and growth that's too fast with wage increases that are much higher because of the super tight employment that we're seeing in the States. And you end up with a situation which is, again, the Fed just not cutting anywhere near as fast as people think.
Right. Well, and the second question, which is kind of intertwined with the first one, because actually, what are your thoughts generally on the future of U.S. bond market, especially considering the impact of the upcoming U.S. elections? So is there any, shall we say, positive impact in terms of which hopeful will likely be elected, or it just doesn't matter?
It's pretty amazing that if you look at Trump's policies, that Biden's policies, from a policy standpoint of economics, Biden is more Trump than Trump was, right? He's much more conservative. He's much more of a warmonger. He's much more about things that would, meaning either way, you're getting policies that still are so similar, meaning they're a lot more central. The rhetoric is, one guy on one side and the other guy on the other side, these two very older gentlemen, and the people talk about dementia and everything else. But the fact is, from a pure policy standpoint, both of them are still very pro-business favorable. In energy and other areas, Biden has come out far more favorable towards pipelines and gas and oil than anyone ever thought he would be. Regardless of who wins, we think, moreover, the economic policies stay. Social policies may be different, but economic policies stay a bit more similar than anyone would think. And either direction, we still think this is not a time to start betting on rates falling and bonds being the best place to be. If you even use a simple risk-free rate of 3%, add inflation, why are people jumping up and down for a bond paying 5%? I can't imagine a bond fund that pays 5% when risk-free plus inflation is already well above 5%. And people are saying bonds are so wonderful at that level. I think this is really a year for bond selection. Another reason to have Cbonds in our research service, because I think just putting your money in bond funds is a very, very, very dangerous thing, given what could happen. versus saying, no, this is the time for bond selection and really being specific and putting your own portfolio together that matches what your endowment or what your fund or your sovereign needs in terms of income.
Thank you very much, Professor. And we have also another question, which is very close, like they are like at the same barrel, I would say, at the same line. Do you expect any surprises in 2024 regarding US financial markets? Anything that we should be prepared for or maybe worried about?
Yeah, our official, and it's funny because in late 2019, after the market did almost 30%, we were very concerned about the market. We weren't predicting a pandemic and a lockdown to hit, but we were saying markets are going to be, difficult, and the markets rolled over quite a bit. That said, by March, April, May, and June of 2020, we were screaming buy all across the board, partly because the credit markets held up so well. All right, they did not tighten and squeeze the way they did in 08, the way they did in 99 and 2000, the way they did in 91. You want to go back to 91. You didn't see that credit tightening. And as long as the credit markets stayed open, equity markets were solid. So, we do believe that the equity markets are expensive at these levels, and that we could see the equity markets potentially going up 5%, but also potentially falling 15%. And so our actual call is 15% down, plus or minus 20. So somewhere between +5 to -35. And what does that mean? That means stock selection and bond selection are king. It's getting into the right names that fit where you are and why you need these kinds of screens and screeners, because just saying, I'm just going to rely on asset allocation and buy a bond fund or buy the S&P 500, that's the most dangerous thing to be doing, I think, over the next year or two, versus saying, let me be specific about bond selection, put together a portfolio that fits, or an equity portfolio that fits what you're looking for.
Right.
Yes, I have the same opinion. So I think we're experiencing a very interesting year for the bonds and for the stocks. So be fully prepared, be fully equipped in order to create your brilliant portfolio this year.
Thank you. And generally, since we covered a lot, we've covered like US bonds, and we're talking about it a lot and the situation in the United States. There is also like a question about, since you mentioned also Professor China in your presentation, and what was happening last year in the Chinese corporate market, a total disaster from many points of view. So the last year was very difficult for the Chinese corporates. Could this impact actually the situation in the developed market bond market, in the developed markets bond market? For example, will there be a shift of capital to markets with greater financial transparency? Will we see another sell-off of the Chinese corporate bonds this year? And maybe will it impact to some extent what's going on in the European and American bond market? Do you expect this correlation to happen?
Yeah, I do believe there will be a flight to quality, and quality means U.S. corporates. U.S. companies right now produce more economic profit than all the rest of the companies in the world combined. U.S. market cap is bigger than the rest of the world combined, and for good reason, because the profits of U.S. companies is bigger than the rest of the world combined. And to the extent that you want to make sure your bonds still pay off, well, why wouldn't you make sure that you're buying bonds of the companies with the highest levels of profits that are most sustainable? So no, we still think it's U.S. Europe is going to still be reeling from this Russia-Ukraine, at the risk of going to jail for 15 years, and I can't visit Russia anymore. The war, right, that's going between Russia and Ukraine, I think it's very dangerous. China is in a 10 to 20-year lost 2 decades. It'll be worse than what you saw in Japan. We are post-peak China, and it'll stay that way for another 20 years. It's bad for bonds because companies don't make money in China. They're being pushed, and you got these zombie companies that are in default right now that, without the bankruptcy laws, just remain in default and just sit there not paying off. I don't think Evergrande is the last of it. The shadow banking in the U.S. from private equity, private credit is very, very strong. I showed that KKR chart. I don't think you're getting that. I think in China, shadow banking and private lending is also drying up massively. Germany's in deep trouble, deep trouble, which is pulling down the rest of Europe. South America, you've got 5 countries that are in deep trouble: Venezuela, Argentina, Chile. I mean, just troubling issues. The safe havens are still where you want to go, and honestly, that really means favoring in general U.S. stocks and U.S. bonds, just not the funds so much as specific securities in U.S. companies where they're still minting profits, even as bad as things are. U.S. companies have done a lot to insulate themselves from both China and Russia in the last 2 to 5 years, in ways that a lot of other companies have not. And I think a lot of people are hoping for a China recovery that they're not going to see. They're hoping Germany is going to kick back in a big way. I don't think you're going to see that anywhere near as strong. I'm not saying there aren't a couple of individual bonds or stocks that might be interesting, but if you're looking for big pools of places to go, one of my screens in Cbonds would be, first, let me find U.S. corporates, right?
Okay.
Even if the U.S., 50% of the S&P 500 is still international. But if I'm going to get international revenue, I'd rather it under U.S. transparency, U.S. SEC corporate governance, and from that, I'm buying international revenue, than get international revenue through a Chinese or a Russian company or something else, where who knows what those governments could do, because they are still very autocratic communist parties, and they have a habit of taking assets when they need it from the companies in those countries. That is not something that happens in the more developed markets. It just doesn't.
Yeah, and we have, thank you very much for your answer. We have a very short question, a comment for Lana, coming from in my direct messages, by the way. Since the person is right, and since you've been a well-seasoned professional and you've been working for a lot of years in Cbonds, what is your estimation? What is going on with the interest for emerging markets bonds this year? Maybe the question is somehow, is the appetite the investors had something like 5-6 years ago, is it gone? Or maybe investors are still interested in some kinds of opportunities that emerging markets offer?
Thank you very much. Well, basically, yeah, I've been working here for about 8 years, and it's very interesting to see how the appetite of the investors is changing and developing within years. So I would say the investor at the moment is absolutely different from the investor. Probably he was investing 5 years ago, and their preferences, of course, are changing. So still, emerging markets are still on the table. Definitely, there are very interesting opportunities at the market where maybe there is also probably African market, Latin America, and Middle East. They are very interesting in terms of the investments and popularity. Maybe something of CE market, probably. And I definitely noticed that currently Asian markets are probably less popular within the last 2 years. So, of course, I understand the awareness of our investors probably within the last 2-3 years. I believe I noticed that mainly investors tend to invest in European and US market. Definitely US market and corporates are one of the top choices. So yeah, we totally agree on this point with Joel. So yeah, definitely the taste is changing. Although I should say now it is absolutely global scope. So probably the key criteria would be the rating, the yield you can get, and of course the transparency, because you need to understand what you're buying, and you need to understand what is the company, what they produce, where their money are, and whether they are able to pay the bills. So definitely, I believe the last year and this year should be absolutely the year of bonds. So I'm very thrilled to see maybe some new names or some interesting names which will appear during the year. who knows? The pandemic really showed us that everything can happen, and we cannot predict everything. But definitely, when you see a full picture, you are fully prepared for everything. So, yeah, thank you very much for this interesting discussion today. I really enjoyed it, gentlemen. Thank you so much.
Thank you.
Thank you very much. When Lana said everything can happen, everything means everything, unfortunately. So from this very perspective, but whether it's emerging markets or developed markets, bonds, you can find all of them, especially when it comes to Eurobonds on our platform, cbonds.com. Since we've run out of the questions, maybe it's time to wrap up a bit today's session. A very insightful one. I want to extend my deepest gratitude, congratulations to our distinguished speakers. First of all, Professor Joel, who was joining us from the United States, from Valens Research, and also Lana, our global clients manager at Cbonds. Thank you very much for your presentations. It was really a pleasure to talk to you. Maybe the best evening ever, I can imagine, in such a company. Thank you very much. Your expertise and perspectives have been very, very invaluable. To our attendees, thank you for joining us and engaging with us. We encourage everyone to stay tuned and be informed by subscribing to the Cbonds Global YouTube channel. You can hit the button below. This will ensure you will never miss out on our bond market webinars, some particular online events we organize practically every month. Additionally, we invite you to register at cbonds.com to request a special trial and enjoy a discount exclusive to our viewers. For more updates and insights, please follow us on our social media channels. All the links will be present in the video description, since we will be going to post it on our YouTube channel. And please do not forget, follow Valens Research for more financial insights and analysis. Thank you very much. Thank you very much once again for participation engagement. It was really a pleasure.
Thank you. And Anatoly, Lana, thank you so much.
See you next time. Yeah.
See you. Thank you.